I feel like you're just drowning in jargon when you look at a company's earnings report or, trying to make sense of an earnings call transcript. It can feel like searching for a needle in a haystack sometimes, right? Trying to find those really useful bits of information. Well, think of the deep dive as your guide through that. Today, we're digging into Anand Rathi Wealth Ltd's Q1 FY26 earnings call. We've got the transcript right here. And our mission really for you is to pull out the key stuff, what's going on with their business segments, the industry picture, where they're headed, and any big risks to keep an eye on. The goal is for you to walk away with a much clearer picture of Anand Rathi Wealth.
Sound good. Okay, let's unpack this. All right, kicking things off with their Q1 performance for fiscal 26 headline numbers. They look pretty strong. Profits jumped by a solid 28% compared to last year, hit 93.9 crores. That's a strong start. And their total assets under management, the AUM, also grew nicely, up 27% to 87,797 crores. They're actually getting really close to that big 1 lakh crore target they've set. Just about 14% shy now.
But the thing that really stood out to me, their net mobilization, a record 3,825 crores. What's really interesting is they managed this even while the overall market saw a slowdown in mutual fund equity flows. Those market flows dropped quite a bit, right? From around 45,000 crores down to maybe 23,000 crores in June. So seeing Anand Rathi pull in record numbers, then that really says something about their resilience, wouldn't you say?
Oh, absolutely, it does. And what's compelling beyond just the growth is how efficiently they're converting that into profit. If you look closer, their profit after tax margin, the PIT margin, hit 33% in Q1. That's up from, 29.9% last year. And the annualized return on equity, ROE, came in at a very impressive 44.4%. So these aren't just big growth numbers. They point to, really strong operational management. They're turning that AUM growth into actual bottom line profit very effectively.
That efficiency really is striking. And I suppose that also helps them move towards that other goal they've talked about, the 50-50 split between upfront and trail income.
Exactly. Getting that balance right adds a lot of stability. Trail income is stickier, more predictable. So yeah, financially, they seem to be on very solid ground right now.
Okay, so solid foundation. But what's actually driving this? Let's peel back the layers a bit and look at the different parts of their business. Their main engine, the flagship private wealth business, that added around 600 net new client families this quarter, brings their total up to 12,330 families. So steady growth there in their core market. But they're not just relying on that, are they? They've got other segments growing too, like the digital wealth business, the B2B T2OC model, for tier 2 cities and simpler needs. Its AUM grew 19%.
Yeah, 19% year on year, up to 255 crores. And client numbers there also rose 23% to over 6,200.
And then there's the O5SS platform. That's their software offering, right?
Right. Software as a service. That's got 6,627 subscribers now. And the platform assets are quite substantial, about 1.58 lakh crores. So this diversification, it's strategically really important. It gives them multiple ways to grow and serve different types of clients.
Makes sense.
And you see the result of this whole approach, the diversification, plus their focus on, like they say, a client-centric, uncomplicated approach, focusing on risk-adjusted return. You see it in their client retention. That attrition rate, it's incredibly low, just 0.1% in Q1. And even regret attrition, where they end the relationship, was only 0.11%.
Wow.
It really speaks volumes about client satisfaction. These relationships seem very sticky. They're clearly doing something right and keeping clients happy.
0.1%. That's practically nobody leaving. Okay, and you mentioned that record net inflow, 3,825 crores. How did that break down? I think I saw the numbers. Equity mutual funds were the biggest chunk.
That's right. 1,983 crores from equity MFs, and about 300 crores from debt mutual funds. A pretty big chunk. 1,062 crores came from structured products, and the rest, about 480 crores, was in other items.
Okay. Speaking of those debt mutual fund inflows, that 300 crore number, wasn't that segment declining before?
That's a really interesting point, actually. Yes, debt MF AUM saw a 9% jump quarter on quarter after falling previously. And the company explained this. They said it was mainly large clients doing STP staggered transfer plans.
Okay, so not permanent cash parking.
Not necessarily permanent liquid money, no. It sounds more like a strategic move, a staggered entry into equity markets. It suggests maybe some clients are feeling a bit uncertain, cautious, using debt funds as a sort of temporary holding area before fully committing to equities. It gives us a little window into current client sentiment, doesn't it? And shows how firms like Anand Rathi have to be agile, responding to those market feelings.
Yeah, that's a good insight into the current mood. Okay, let's shift gears a bit. Let's pull back the curtain on the people side, their relationship managers, the RMs, and how that connects to costs. There was some talk on the earnings call about operating expenses, OPEX, not quite growing in line with revenue, a divergence, they called it. Honestly, when I first saw that, I scratched my head a little. Seemed off. Can you walk us through why that might be?
Yeah, absolutely. It's actually a really key part of understanding their specific model. It's not about, say, cutting costs randomly or changing how they pay people. It's mostly down to their newer RMs becoming more mature, more productive.
Okay.
See, a new RM has a fixed salary cost from day one, right? But they don't start earning incentive pay until they hit a certain revenue generation threshold, which Anand Rathi defines as 4 times their salary costs.
Right, the 4-act RSR.
Exactly. So there's a lag. The fixed cost is there, but the variable incentive cost only kicks in later when they become productive. As more RMs cross that threshold, they boost revenue significantly, but the variable cost component doesn't jump proportionally right away because many are just starting to earn incentives. So OPEX growth looks slower relative to revenue growth temporarily.
Oh, okay. That makes a lot more sense. It's like a deferred cost structure that starts paying off as the RMs get established.
Precisely. It shows they're playing the long game with their talent.
And speaking of talent, their whole approach to adding RMs is quite different, isn't it? Mostly promoting from within.
It really is distinctive. They said about 80% of their new RMs come from internal promotions, not just hiring laterally from competitors. They actively manage the pipeline, too. The number of non-mature RMs, those managing less than 40 crores, dropped quite a bit, from 93 down to 54 this quarter.
So that creates space for promotions.
Exactly. It frees up capacity. And they mentioned the next batch. About 100 RMs are already in training. This grow-your-own approach, it likely builds incredible loyalty, a strong internal culture. They seem to be betting that this is a better way than constantly fighting for talent in the open market. It could be a real competitive moat for them.
Building that loyalty and culture from the ground up, that's fascinating. They also mentioned regret RMs, didn't they? People leaving or being asked to leave.
Yes. 2 this quarter, 1 last quarter. They framed it often as cultural misfits. It suggests they're pretty disciplined about maintaining that internal culture and efficiency. If someone isn't fitting or performing, they seem willing to make a change.
Right. Weeding out inefficiencies, as they put it.
And interestingly, management seemed open to an analyst's idea about providing more detail on RM productivity in the future, like breaking down AUM contribution by how long an RM has been with the company, less than 3 years, 3 to 5+ years. That would give even clearer insight into how that maturation process works.
Yeah, more transparency there would be interesting. Okay, let's broaden the view now. Industry outlook, especially around structured products and also their global plans. The call mentioned some recent market stuff, the Jane Street episode, and SEBI, the regulator, trying to clamp down on F&O volumes, futures and options trading.
Right, and what's really insightful here is how Anand Rathi views the SEBI changes. They actually see it as a positive thing for their structured products business.
How so? Usually clamping down sounds negative.
Well, the specific change was moving from using notional contract values to delta values for calculating option limits. It sounds technical, but the old way could be easily manipulated. A cheap, out-of-the-money option could have the same notional value as an expensive one, allowing huge positions to be built up deceptively. Using delta values, which reflect the option's actual sensitivity to price changes, makes it much harder for manipulators.
Ah, I see.
So SEBI's move, according to Anand Rathi, actually creates impediments for any manipulator. It strengthens market integrity. And crucially, for a firm playing by the rules, it doesn't hinder their legitimate structured product business. In fact, it might even help by making the market safer and more predictable.
So a regulation aimed at curbing speculation actually ends up helping the legitimate players. That's counterintuitive, but makes sense.
Exactly. It shows how good regulation can sometimes be a tailwind for responsible firms.
Okay, so the regulatory environment seems manageable, even helpful. What about their own growth ambitions beyond India? They mentioned international expansion. They've had the Dubai office for a decade, right?
Yeah.
And now looking at the UK and Bahrain.
Yes, they have. And the strategy seems very clear. It's about tapping into the huge growth in NRI non-resident Indian interest and investing back into India. They see things like Gift City and the growth of alternative investment funds, or AIFs, as creating really effective ways for NRIs to pool money and invest. And they're using that brick-by-brick approach you mentioned earlier. Prove the model in Dubai, build experience, then look at places like the UK and Bahrain. It's not a sudden land grab.
Right.
It's a methodical expansion, betting on India's continued appeal to the global Indian diaspora, leveraging their existing expertise to capture that growing market.
A very clear strategic direction there. Okay, so we've seen strong performance, diverse business lines, a unique talent strategy, and a positive outlook on regulations and global growth. But let's talk targets and shareholder value. Some listeners, maybe you, might look at the numbers and see a bit of a gap. Their AUM is at 88% of the full-year target already, which sounds great. But revenue and profit are only around 24–25% of their full-year guidance. How do those pieces fit together?
Yeah, that's a really sharp observation, and it did come up on the call. The company's explanation is quite helpful for understanding these kinds of metrics. They describe AUM as being like a photograph. It's a snapshot of market value at one specific moment. It can swing quite a bit based on market movements, especially near quarter end.
Okay.
Revenue, though, they called a movie. It's generated continuously, day by day, from the underlying business activity. So a temporary market dip might pull the AUM photograph down, even if the movie of revenue generation is running smoothly throughout the quarter.
That's a great analogy. Photograph versus movie.
Isn't it? So they basically said, don't worry too much about that apparent gap. They're confident they're on track for their full-year guidance. That's 20% revenue growth to 1,175 crores and 20–25% PBT growth to 375 crores. And they pointed to their history, their track record of generally undercommitting and over-delivering. It makes you think about how we evaluate targets in volatile markets, doesn't it? Need to look beyond just one number?
It really does put those quarterly numbers in perspective.
Yeah.
So focus on the movie, not just the snapshot.
Got it. What about shareholder value more directly? Any talk of things like stock buybacks?
They address that too. The current stance is no buyback plans discussed internally right now. They mentioned that the tax rules around buybacks have changed for shareholders and making them less tax efficient than they used to be. So instead, their focus for shareholder value is really on, consistent dividends and building what they termed a compounding business. They seem to want long-term investors who value steady growth and predictable returns rather than relying on financial engineering like buybacks. Okay, a focus on organic growth and dividends for the long haul. Makes sense with their overall conservative approach. All right, so wrapping this up, what does this all mean for you?
Well, this deep dive shows Anand Rathi Wealth had a really impressive Q1. Strong profit, strong AUM growth. They've got strategic diversification working for them. Private wealth, digital wealth, the O5 platform, and that unique RM talent model focusing on internal promotion that looks like a real edge in managing costs and building loyalty, almost like a competitive moat. Plus, they seem optimistic about expanding internationally to capture NRI flows, and they view recent regulations not as a threat, but maybe even as a positive.
And maybe a final thought to leave you with. Consider how much a company's internal culture and how it develops its people, like Anand Rathi's RM strategy, can be just as critical for long-term success, maybe even managing risk, as things like market timing or fancy products. It makes you wonder, doesn't it? What other industries could really benefit from that kind of deliberate, brick-by-brick focus on human capital? And how could you spot that kind of strategy when you're researching other companies? That's a great question to mull over. We hope this deep dive gave you a clearer, more insightful view of Anand Rathi Wealth. Take these takeaways, think them over, and maybe dig a bit deeper into what caught your interest.